And for any of those who don't know, this is Boyd Brown. He's the owner of multiple different market centers here in Utah. But probably the most unique thing about Boyd is how old he is. He's basically ancient, and he's lived through a lot, so he knows what he's talking about. So without further ado, Boyd Brown, take it away.
Thank you. I am old. Can you switch the screen so I've just got me? Or you want to leave it there? Okay. Thanks, guys. Yeah, it was just me and Lee Stern at the turn of the century. Thanks for that. Appreciate it. So today's class, I really wanted to, I thought this would be really market of the moment opportunity for us to talk about. As I've been paying attention and thinking about what's coming down, it's been incredible how many deals are getting done right now. And I've been encouraging everybody to get things that you have in the pipeline closed while you can right now, because I really think in the next 30 to 60 days, as we get further into this shutdown, more businesses are going to be closed, and these operation centers for the mortgage companies, I'm already starting to see appraisers giving some pushback and coming out and show. So it just occurred to me that getting deals processed and done may become more cumbersome in the next, say, 3 to 4 weeks. Does anyone else kind of feel that's what's coming next? Okay. Thank you. Appreciate the interaction. The piece of that, why I think seller financing can be so critical, is that we really have seen buyers and sellers that still want to transact deals. And particularly even during COVID, there still are divorces, there's marriages, there's job transfers, there's people losing their jobs, there's people that want to be investing, there's all sorts of reasons that people still want to transact real estate. And you guys have done such a great job staying in communication with your clients. I just want to present this sort of as a mindset of ways to get deals done. So just by a show of hands, I've got half of you on the screen here. How many have done some form of seller finance deal in the past? A few of us, okay, great. Seems like there hasn't been a lot of it lately. We saw, the last time I saw a lot of seller finance deals was sort of in the downturn, the last time people's credit was banged up, or maybe they were over encumbered for some reason they couldn't get out of it. Recently, there's been so much equity in homes, and financing has been pretty easy. We've seen a lot of traditional financing, and if you can go get a primary mortgage for 3%, why wouldn't you do that? So my thought on this right now is that one of the blessings of this market is for the last 5 years, we've had such low interest rates. So all these loans have been done, and the underlying loans on most of these properties, if we are going to look at do seller finance or wrap something, typically are phenomenal. I mean, almost everybody has 4% or less on their, at least on their primary residence. So what I'm seeing happen, and this was spurred by Heather, who I'm not sure, is Heather on this today? From Orem? Not you, Heather. Thank you. I saw you there. Okay, I guess she's not. I got a email last week from one of our agents in Orem where she had someone, she had just sold a condo or a townhome to about 1.5 years ago, and they were a no money down FHA. They bought it, and just like everyone else has done, they've already refinanced at least once in that case. So they have a reason they absolutely have to sell. They bought this townhome for $200,000 or $300,000. They've refinanced it. Now, of course, the cost of that refinance is on top of their loan. Even though they have a great interest rate, right now they're sitting at about $309,000 on their principal. She did a CMA and basically came up with, in that townhome community, the sales price is probably about $309,000, maybe $310,000. And so she was wondering, how can I get them out of this? And we were brainstorming on some options, and seller financing was one option. Certainly one option they have is to become a landlord and lease it out. Not everybody is set up to do that. The other option that we talked about was either do a lease with an option or the seller finance. So for this case, and we'll certainly take some questions, I thought I would walk through kind of how that deal would look like. Does that work for you guys if we walk through an example? Okay.
Yeah, that'd be great.
Great, thank you.
Boyd, can you say that one more time? Just the story again. I'm sorry. Just say that one more time. What's the situation?
Yes. So the situation is you have somebody that's essentially over encumbered. So they owe 309 on a property that is probably worth 309. And there's a decent chance as people continue to freak out in the next 30 days, it might be worth 300 today if they need to get it cashed out. Does that make sense? So we're back in a situation where we haven't been in a long time. Like in the short sale era, we're in a situation where people actually had to write a check to come into close. There's a few of you I see on this call that have been around long enough to remember that. It wasn't a great feeling, and none of us have seen that for 6 or 7 years. But the reality is for Heather to get that listing and to list this property with a 6%, and if they got an offer at 309, then the seller would have had to come to the table to write a check for the commission, basically, to get out of it. So this is she sent me this as the MLS, just to give you guys a context of what we're talking about. This is the property when they purchased it in 2018, so not quite 2 years ago. Townhome in Cedar Hills. Pretty typical transaction. I'm sure a lot of you have sold townhomes for $300,000 to first-time home buyers on FHA loans recently. So this is, I just shared this in the remarks. You should have a link to all this stuff that we're going to go over, but I just want to walk through kind of how we would set that up. Actually, let me do this. This is not, can you guys see my screen okay? Okay. So this is not a Rep C class, but the first thing you would start with, if you're going to present a seller financing option to your sellers, there's certainly some risks, and we can take some questions and answers to that. In this scenario, I'm just going to walk through what we do on a seller finance addendum. So let's say she's got a buyer in place. I suggest.
Wait.
Go ahead.
We see the MLS sheet. Is that what you're meaning for us to see?
No, let's see. Let me take that down.
So you may have shared just that sheet instead of your desktop.
Yeah, just hit resume share. Are you seeing that now or no?
I'm still just seeing the MLS sheet.
Okay.
So maybe hit stop share and then share again, and then perfect. You got it.
Thanks for your help, tech guy. So this is in our multiple listing form. Maybe you've used, maybe you haven't. It's a seller finance addendum. So let's assume, and what I recommend is that she does put this on the multiple listing, or at least take it out to her sphere of influence or agent for buyer. And so we can talk about this also as question and answer. The reason I've used seller financing to acquire a number of rental properties for myself over the years. So I want you to think not just in terms of helping your buyers who are first-time buyers or your sellers, but what deals can we get done in the next 30 or 60 days where we're actually acquiring properties for ourselves, or so many duplexes and fourplexes have been sold to non-real estate people in the last couple of years. You know, if they don't get rent for a month or two, there could really be some don't wanters or absentee landlords out there that are dying to get out of some of these income properties. It could be a great opportunity for you and some of your investor clients or yourself to come in with less money than you would need to on commercial financing and acquire that property. So a lot of those same principles will hold on this. For now, I'm going to just walk through the seller financing addendum with you guys to see what you would add to the purchase contract. Before I start that, are there any questions right now, or is everyone tracking to where we are on this? No questions? Okay. So assuming someone put a purchase contract together, the only thing on the Rep C that you'd have to change is that in the financing section, you would check on the first page that there's seller financing, and you would put the amount of financing due on that. So on this one, Heather did share with me that her buyers owned approximately, I believe it was $285,000 on this, or actually, I think it was $309,000. Whatever, if you can find out from a listing agent or your seller how much is due on the loan, you would want to have at least that much for the seller financing amount so that your buyer would then come in with the bridge, the gap for that much as their down payment. We'll assume for this that the amount owed is $300,000 and the purchase price is going to be $320,000. So your buyer, or let's say I'm the buyer, I'm going to buy this as a rental property. In the Rep C, I would write it up for $320,000, $20,000 cash due at closing, $300,000 would be the seller financing on that first page of the purchase contract. The only other place you would need to mark that is in the addendum section of the purchase contract where it says additional addendums. There is a box to check for the seller financing addendum. This seller financing addendum you would add to the contract. Very typical, we put the date on there that ties it to the contract. Identify the buyer and the seller. The credit document, whenever there's an underlying note, it's an all-inclusive deed of trust. We also call that a wrap. Essentially what we're doing is, let's say the underlying mortgage is with Citywide Mortgage. That mortgage is going to stay in place and we're wrapping behind that. So there'll be an inclusive trust deed and note, and the Citywide still has first position on that, and the all-inclusive note that you have money owed to the seller will be essentially in second position behind that. If there is not a deed of trust, no mortgage on it, which is very unlikely, but if you do have an investor that doesn't have a mortgage at all, you can just use this note and trust deed. When you get to closing, the terms that we spell out on this real estate, the seller financing addendum, the title company will create the note at closing for you that'll be signed just like the mortgage document. It'll just be a lot less paperwork than a full mortgage. We put in here your credit terms. Basically, this is a chance to negotiate. Again, interest rates are so low right now, you would like to find out what the underlying interest rate is. So I think these guys had an underlying interest rate of 3%. I would propose in here that they're going to loan me $300,000. And if they have 3%, you may, in the past, I've offered a higher interest rate so that they're making a little margin on the spread for their trouble. In this case, I think maybe they're fairly motivated. I would just offer that I could assume and get the same interest rate that they have. To get the amount payable, we can go and run an amortization schedule, or one easy way to do it is just find out what their payment is on their current loan. You could put it in that way. And in the MLS, there is in the tool section, you can just pull a quick amortization to see what a $300,000 at 3% would be. And if you amortize that over 30 years, I'm going to estimate that to save us time of $1,850, make that per month. Now, this is the key to this. I think the market of the moment right now, most sellers don't want to be tied up and still have that credit in their name for 20 years of a loan. What I'm suggesting right now for us to think about is that the way we can make this compelling to sellers in the market is that we make that payout pretty quickly. So in here, I would put for myself that this is due in 12 months. If I was the seller, I would want to have that done sooner. If I'm the buyer, I'd want it later. My mindset when I was buying investment properties is I typically would look to a 3 to 5 year balloon payment so that I would make all these payments on seller financing, create value. Hopefully the market goes up to create some equity, and also I can create some value by managing the property and doing some improvements, with the ultimate goal is that if I can raise the appraised value in 2 or 3 years, I can just get a refinance, no cash out, just refinance and not have to put any money for down payment or any additional than the $20,000 I had. So this, when it's due, is certainly negotiable. I think traditional on seller financing is about 3 years. And I'm just thinking, for the way the market is right now, if we can present to somebody to say, hey, you get some cash, you get to move, the buyers get to move into this townhome, we're going to let this COVID thing run its course and get back to normal. And we think within 12 months, we can actually go out and get our own loan. I think that's a mindset for you guys. And it's not just on these homes with no equity and no cash down. I think move up homes where people have significant equity, and some of your buyers that have $100,000, maybe they closed on their home, but they can't get financing on jumbo financing, that we can do deals with, you know, $100,000, $200,000, $300,000 down and still wrap that underlying mortgage and just push out the closings until, or the financing for 6 or 12 months, so that we don't get held up in the process on any. I mean, I really feel like there could be some delays coming. Does that make sense to you guys? Okay, great. Taxes and assessment, I typically say that they're directly paid to the seller escrow agent on a monthly basis. You would want to include that. I think you don't want to have the risk of going back and chasing the buyer for the tax and insurance money at the end of the year. I always set these up with an outside escrow company. I've used escrow specialists for years. There may be a few others in town to use, but there's some real great advantages to using escrow specialists. They keep a record of everything, and then when your buyer makes that payment to escrow specialists, they directly pay the mortgage company, and they're also make sure that the taxes and insurance are paid. And it's great to have a third-party accounting of all this, so at the end, you're not debating whether they made the payment or didn't make the payment. I think something to think about that is pretty important as a risk for your sellers, if they're not set up through escrow specialists, there's always a risk that your buyer is paying the seller financing and the seller is no longer making payments to their underlying mortgage. That would really put us all at risk, because if they don't do that for 3 or 4 months and there's a foreclosure, that really puts our buyers at some risks. As I said, there's some risks related to this that you want to talk to your sellers about and buyers, but I think having that escrow specialist helps offset some of that. Late payments, I typically put in there anything not paid in 10 days gets 5% a late fee, and default rates at 18%. That's just what I've seen done other places. Due on sale, this is another thing. If you're doing these deals, it's important for you to be able to communicate and talk to your clients, whether it's buyers or sellers. Almost every mortgage that's written in America, certainly anything that's Fannie or Freddie, FHA, has a due on sale clause on it. So one of the lines in a 60-page mortgage document is going to say that when this is sold, it is due. That gives them the opportunity to call the note due if they know you've sold it on seller financing. I have, in 24 years experience, never heard of a note getting called due because of this. And as long as payments are made, no mortgage company right now is going to go try to foreclose on properties. They have bigger problems to worry about right now. But there will be a disclosure required that both parties sign and say that that is the risk, that at some point, if Citywide, Wells Fargo, whoever it is, says, hey, you know what, Boyd, you sold this to Justin, we don't like that, we're going to call the note due, that does create some pressure on buyers and sellers. Again, it's something you want to address with them. I have not seen of or heard of in 24 years of doing real estate any mortgage company calling a loan due if people are making payments. The other thing you may want to talk about in here is a title insurance. Technically, you don't have to have title insurance to close a seller financing deal. I would strongly recommend that you do have it, and the title company in the state of Utah will not close it unless they're issuing a title insurance policy. I think most title companies are comfortable doing these transactions. I know that Integrated Title has closed them for me before. I've talked to Real Advantage. They're all set up. All the escrow officers at Real Advantage are able to do these right now. And I think most title companies that you work with will be able to transact these. One of the other questions in here to address is how much information the buyer will provide for the seller. In here, there's a buyer disclosure. It just talks about turning over IRS, your tax forms for the last 2 years. again, if you're going to try to convince your seller to do seller financing for someone, I would think that at the very minimum, you would ask for a copy of their credit report and their tax returns, just so that you know that they're credit worthy. Obviously, I'm not suggesting that we go do deals that are going to put our sellers in jeopardy if it's someone that doesn't pay their bills. So I'm going to stop the share on that one for a minute and then just open it up for questions. What questions do you have about that form, or any comments on being able to do those deals?
Hey Boyd, it's Dean.
Yep.
What do you recommend as far as ballpark figure of percentage of dollars put down to consider doing seller financing versus a lease to own option?
Whatever is significant, and I think it depends on the seller's situation. So if I'm in the seller's camp, I'm trying to get as much money as I possibly can to solidify that deal. So if I have a house in South Jordan that I'm selling for $700,000, and I know that typically a buyer on that would come in with 10% down or something, I would require at least 10% down. On the entry level, hang on, Rena, just a second. On the entry level, something like that Cedar Hills townhome, typically that's going to be a first-time home buyer, or maybe closer to the lease option. I would say that I would want to have at least $10,000, 5,000, something like that down. The other piece, Dean, that comes up in this is how we get paid our commission. So if there's no money down for the transaction, again, you all decide who you work with. Most buyers, if they don't have 10 or 15,000 bucks or 20,000 bucks to put down, they're not in my car out looking for properties right now anyway. So that's a decision. If they are fully qualified and we're going to get a grant, some of those things you might look at it. But I would look at, enough money that's going to hurt if people walk away from it.
Great, thank you.
I would say if they're stuck with $3,000 to $4,000 or $5,000, then we look at the lease option.
Not a question, but a comment. Having done some seller financing, is to make sure that you don't set your buyers up to fail. So if it's a credit issue, make sure you make the balloon long enough with a plan in place with a lender, and track the plan so they don't get to the balloon period and they have no ability to refinance, and the seller could call the loan due.
Yeah. And I over the years, a lot of the reasons why you would use seller finance is if someone has bad credit or is recovering in credit, you want to give them time to establish that credit. And I think that's possible now. I also want us to think about, these could be good transactions right now with people with good credit that are packaged, and we just are concerned because of what's going on with COVID that we're not going to be able to get a loan done in 3 weeks or 4 weeks or something to make the transaction happen. It could be that you have a transaction at the beginning of one of these triangle deals where one has to close for another one, for another one, for another one, and we can sort of free up some of that equity with seller financing also. So, Rena, you make a great point. If the goal is that I don't have strong enough credit right now to get a loan, but I have a nice down payment that my dad loaned me or something like that, and I want to establish my credit, then you're right. Probably 3 years history to work on my credit before that balloon is due is right. And again, I think we have to be responsible on this. This isn't about putting people in homes that shouldn't be buying homes right now. It's really about being smart for both your buyers and sellers.
Boyd, I've got a question.
Boyd, it's, oh, sorry.
Let's do Alan first and then Jen.
Okay.
Thanks. I've got a question. So when you're with, when you're closing this in at title, are you encouraging them to use like trusts or anything to help avoid that due on sale clause? Or are you just kind of saying like, hey, this is the risk that you guys are taking and we're just going to change the title into the name of the new buyer and that's it?
Yeah, I think everyone has a different opinion on that who's done them. I just say that's the risk that's taken, and almost every title company has a disclosure that both parties have to sign. It is also disclosed in that seller financing that just says, you guys understand this is the risk.
Okay.
The one thing that advice I was given years ago is to make sure that you keep the same homeowner's policy in place. that
Right.
is one thing that can trigger to the lender that there's been a change of ownership when that notice is given. And
Right.
I've done that over the years, but I've also done some where I haven't done that. I've actually gone out and got a new insurance policy and not had any trouble. I think our concern was more, I'm trying to think of a scenario of why a lender would want to call a note due right now. I mean, with everything going on, everything we're all trying to avoid, our government is trying to avoid, all lenders, is a rush on foreclosures and short sales and defaults. But I know that with the unemployment, there are going to be some defaults. So the banks are going to have their hands full dealing with that stuff. So if I'm making my payments to the citywide on this deal in Cedar Hills and they're getting their payments from escrow specialists, they are not going to come knocking on the seller's door saying, hey, why don't we file a default just to give us something more to do, if that makes sense.
Yeah, it makes sense. Yeah. Thank you.
Jen, you had a question?
Yeah, regarding exit strategy. So what is the language if the buyer can't qualify during the time period? Do they have the right to sell it at a loss or a profit? So I'm just trying to think of exit strategies. If, a 12-month term seems sort of short, especially if people are rebuilding credit, in that case.
Yes. So again, what I agree, and if it is rebuilding credit, I believe you want to give yourself more time. What I'm suggesting is right now, if we're using this as a method to get deals done right now, I don't know that every seller is going to want to say, okay, I'll do seller financing and wait for 3 years. And so what I was suggesting is it might be, if we offer that shorter term, if we have an A-plus buyer and we know they can get financed, so we're not as concerned about it, then do a shorter term as a way to entice the seller to actually do it. Does that make sense?
Yes.
Okay.
And
so then on the exit strategy, if once I own the house on seller financing, Jen, I'm the owner of the home. So as a landlord, when I'm buying properties, rental properties, and acquiring them, that's part of my exit strategies. If the market goes up well enough, even if I can't finance it or get preferred financing, I can put it on the market in hopes to sell it and get out of it enough to pay off the underlying note. And so I have full rights of ownership. Once I do seller financing, I'm on title. That's completely my decision, as long as I'm making my payments and I'm not in default with the seller. The seller becomes like any other lender citywide. They have nothing to say with the property. As long as I'm making payments, I own that property. They become the lender essentially. Now, if I'm in default and not making my payments, then there's terms in that note when it's closed that'll be set up at title that they can come and foreclose, file a notice of default just like a lender could, and they could go through the process of foreclosing on me and or evicting me.
Boyd, it's Lisa.
Hi,
Just
Lisa.
a question on contract for deed. Do you use that at all when you're doing your seller finance deals?
I don't, but I know that that's a pretty popular way to do it. There's a title company in town who loves those and spends a lot of time training on them and does CE classes. And I've debated with him a number of times over that. I think there's some advantages. They're probably more tilted towards the advantage to buyers than sellers. I feel like there's more protection on those. And after looking at that and debating them, I made a decision that I would rather do the all-inclusive trustee to note, have it recorded. And I think it's a personal preference on that.
Okay.
You have some information on that you wanted to share with the group, or?
Well, the only seller finance deal I've done is with a contract for deed. So the actual title doesn't transfer to the buyer.
Yes.
So if you're a seller, then from what I understand, you don't have to do a foreclosure to get that property back. You deliver a letter or something, and then in 30 days you can have the property.
Yes, that is what they teach in that class, and I think that's debatable from a legal standpoint. It does, again, I think it gives because it's unrecorded, the seller is still the owner, and I feel like there's some risks related to that. I do like it that if someone defaults, if you're dealing with someone with bad credit and you don't have much confidence in them, that might be a better option because the process of getting them out is quicker because they're not on title. And again, I think that's a personal preference. I really don't think I would ever do a deal like that and feel comfortable enough without having that recorded. Because if I'm buying from Alan, I still feel like there's an opportunity that he could further encumber that property and jeopardize the contract because I've got an unrecorded deed. Good job, Alan. Okay, any other questions on that?
Oh, I did ask the question in the group chat earlier about Utah housing loans and if that's been a problem with the due on sale clause.
Yeah, I think I would avoid the Utah housing because I'd have to look at the language in that, but I believe that most Utah housing loans, and it's been a while since I've closed one and looked at one, that they do have some prepayment penalties and some pretty serious owner-occupied commitments. Most FHA loans do have owner-occupied commitments, which means your intention at closing is to owner-occupied. If your life circumstances change and you have to get transferred or something like that, there's not an FHA police coming to look to see if you're still owner-occupying that. But I do believe that the language in the Utah housing loans is quite a bit stronger that does require that you are using that as your primary residence. And so I would have to look at that a little more and probably get some legal advice from either title or an attorney, but I would probably try to avoid doing this on a Utah housing loan.
Is this where Utah housing is a second mortgage? Is that something that could just be paid off at closing?
You know, I don't know the answer to that. I'd have to look at the Utah housing notes. I think, yeah, I wouldn't want to comment on that. I think.
First and second.
Go ahead. Say that again.
Isn't Utah housing is first and second year paid both payments to Utah housing?
Yeah, that might be a great question for an attorney or a title guy. I don't know that I'm prepared to answer that. I would say in general, I would avoid that if I were the agent on the transaction.
VA loans are the same as FHA then, as far as this is concerned?
Yeah, and I wouldn't be as concerned about wrapping a VA loan. I would, obviously, where people get in trouble is, and certainly agents, you wouldn't want to do that. I mean, if you're acquiring a property for the sole purpose of turning it into an income property or a second home, or of trying to make some profit doing seller finance or lease option, that is in violation of FHA of the laws, and I mean, you will get, it may catch up to you, and certainly anyone who's a licensed real estate agent doing that, I think that's a big no-no and probably a good way to give away your real estate license. Any other questions on the seller financing, Doc?
I have one.
Okay, go ahead.
This is Lorraine. Hey, my dad sold our house that we had when I was in high school to a couple, and they and he financed it for him, but he would not let them refinance while they still owed him money. Is that how that usually works? You just stick with the original agreement?
Sorry, I got distracted. I was looking at the chat box over here. Go ahead. Sorry, Lorraine.
Okay, so in my dad sold our house that we lived in when I was in high school. So the people that bought it, he had, I don't know how I figured out how much interest to charge him or anything, but he would not let them refinance. And I was just wondering, is there some kind of rule against that, or did he just want to make that extra interest off of them?
He wanted to, and he was smart about it because he wanted to make that interest. And sometimes it is a way to juice this up a little bit, or like for an investor or someone like your dad, let's assume he didn't get as much money as he was hoping to get on the sale of that property. But he thought, boy, if I charge these guys 10% interest for the next 5 years, over the accumulation of collecting all that interest, I'm going to get closer to the amount I want.
Okay.
So in that case, it was his desire to keep that, and he would rather be getting their payments than have them get a lower loan and pay that out, because that's almost like having a return on an investment, a guaranteed return of 10%, which is pretty attractive.
Right.
So one of the things you could do then is put in the addendum that if a seller's in that position, you could say that there is a prepayment penalty, or that the loan must be fully amortized for 5 years or 10 years before they refinance it.
Okay.
That's a strategy we've used on land sales and other investment properties, just to tell someone, a landlord, to say, hey, we're going to get you an 8% return. If you take the cash and put it in the bank, you're getting less than 1% return. And so if this investor, I mean, we did a deal with $500,000 down, and the investor carried $1 million. He was 75 years old, and he loved getting I think on that deal, he got 6.5% interest on the $1 million that he carried, which was for him a very safe investment. Right. And so where that would come up is you would want to specify that on the seller financing addendum or on an addendum to the purchase contract, that there would be either a prepayment penalty or that they have to carry out the term of the loan for X amount of years. And that note, just like when you close any other transaction, a mortgage company prepares a note and delivers it to a title company. The title company will create a note which spells out those terms. That'll be a recorded document.
Okay. I just didn't know why he wouldn't let them refinance, so, but now I do.
Just because he was a savvy investor and he thought that was a good return and he didn't think they were going anywhere.
That's right.
I mean, again, if he's got a bunch of their money already and they love it, they're treating it like a home, which is part of the reason why, you know, this is better than just renting the property. If you just rent it, then they're tenants. If you have them on a lease with an option or seller financing, they treat it like their home. They have pride of ownership. There's a higher likelihood that they're going to hang in there and treat the property well.
Okay, thanks.
Let me just see. I have a couple questions over here. Make it at least the amount owed. Okay, Carrie, so at least the amount owed would be, in most cases, if we go back to the townhome we talked about, if they owe $300,000 on this, you would want the note to be at least $300,000 so that don't have a negative number. So if they agree to do seller financing for $280,000 and you've only put $20,000 down, they still have a deficit. There's $20,000 gap from what they're getting and what they still owe the bank. Does that make sense, Carrie? Okay.
I have a question.
Okay, go ahead.
You said you often keep the same insurance on the house.
Yes.
How does that work?
Just as part of the transaction, I communicate with the seller and say, who's your insurance carrier on this? And I call them and say, hey, Farmers, I would like to be named as an additional insured on this. And because if the insurance payment is set up as an escrow, then that is included, remember, on the contract that's included in the payments to escrow specialists. And so that payment will be made from escrow specialists directly to the mortgage company. And then you just would have yourself added as an additional insured. I did a transaction on a development deal in Saratoga Springs where I just went and I was named as an additional insured with the seller's policy. But because I rented out the property, I also wanted additional coverage. I went out and got a secondary coverage. We had 2 policies on the property. It made me feel more comfortable about my liability. I don't think it was necessary. It was a little overkill. But as long as that underlining one was still in place, there was no notice given to the lender. I think, Lisa, you would want to communicate that to the seller. Hopefully they would be comfortable with it and have their blessing before you call their insurance company.
So that means they remain on the policy as well as you remaining on the policy? Is that how you're saying it works?
That's how I've done it in the past, yes. Because they're an additional insured. They're just like a lender. Citywide is named on the insurance policy as a beneficiary. And so in this case, they just changed, basically, they would still be on there. So Alan is the seller, Citywide is the lender, they're insured. So the last person to get money would be me, the buyer. Because if it's a total loss, then Citywide is paid first, Alan is paid for what he's owed on his note, and then I would be the last one to get paid on that situation. Alan, you're doing well today. Okay, any other questions? Okay, The next thing I want to talk about while I've got you guys is lease with an option. Again, hopefully you see this as an opportunity to get more deals done right now. Are you guys seeing my MLS forms on the screen? Okay. So another deal to look at right now in the market, I think, could be a lease with an option. And again, I've used these to acquire properties for rentals. And it could also be a way in a case, and again, I'm just trying to think through what may happen in the market. And there could be people that really want to do a transaction but don't believe they have the time or the capacity to get through something. Let's say I just had a kid or I just got married. My mother-in-law is driving me nuts. I can't stay in her basement for one more minute. And I really want to move into this vacant house that one of our agents has listed. I think the lease with an option is a possibility also. That protects everybody. Even if you have a transaction that's under contract right now, how many times have we had a delayed closing and a buyer still wants to move their stuff in? Or they say, oh, can I just get in this weekend? And as agents, we usually want to advise them, hey, there's a lot of risk to that. If this loan doesn't fund, I mean, are you insured on this? How do I ever get you out? How do I evict you? This lease with an option, or at least having something in place. So if you already have an agreed upon purchase contract and you feel like it's going to be extended for a period of time, you could put just a regular lease in place to protect everybody. This option, lease with an option agreement is on the multiple listing. I don't know how many people use it. It's probably least used, but when I started reading through it for this class, it really is a terrific contract. We used to use a different one, but I think I would go to this one. And basically it just spells out all the terms just like a purchase contract, but it starts off as a lease where you identify who the landlord is and the tenant, the option money and the amount. Again, if I'm the seller or the seller's agent, I want to get as very much money as I possibly can for that option, something to keep them in it. So if we were talking about that $300,000 townhome, maybe it's $5,000. So if I was going to rent it, I probably would be able to move in with a security deposit and 1 month's deposit. And so I'm adding, in addition to that, $5,000, which is just an option contract. What this states is that money is the seller's. You're purchasing an option. You don't get that money back, but if you do close, as spelled out in the terms of this, that does apply towards the purchase price. Same as any other contract, you identify the property, go through disclosures, tenant's right for due diligence. This is interesting if you're trying to get a deal done real quickly. And again, I think we could make deals happen in 4 or 5 or 6 days on this. You would still, however, if their goal is to close, you'd want to pull a title report, get their seller's disclosures, and do a home inspection. That's probably a little more than someone would typically do if they're a tenant, but they're going to agree to a purchase price here. So I think as buyer's agents, you certainly would want to have them agree to do that. So this form does give you that option for due diligence. Term of the lease, again, this is all negotiable. And again, for the market of the moment, thinking about doing this just to make deals happen in this little COVID moment that we're in, I put in here that this is a 1-year lease. So it gives everybody a year to get in and make sure they have their financing in place, and they could close anytime sooner than, but no later than a year from now, the 12th of April. And again, those are dates that you can negotiate completely. Spells out when they can take occupancy. Here's another thing that I think on some of these seminars and stuff of how to control property, they talk about the buyer getting the full credit for the rent towards their down payment. Those of us that own properties, that doesn't make any sense because we're still making mortgage payments and interest. But I do like the incentive, and I've even offered to some of my tenants to have a partial credit of their rent to go towards a purchase price if they're going to buy the home. So in this case, we're just assuming that they're making a monthly rent payment of $2,000, and this was on that $300,000 townhome. I'm also collecting a $2,000 security deposit, which if they move out or make a mess and don't do their deposit, I get to keep their option money and their security deposit. And then we're specifying later in here all the things that are included, but I am going to give them potentially a couple $100 of that rent that will go towards their purchase price if they close. So in this form, I'm offering them $200 a month. So if they close in a year, it's not a lot, but they're getting a $2,400 credit that can be used towards their down payment. Down here, when you get to section 5, it spells out the purchase price. I have seen lease with options where you leave that open and you say to have an appraised value at some point in the future. I think to do deals right now, you're better off putting a set purchase price in there, have a better chance of getting someone to close on it. If the market goes backwards 20%, we're probably going to have to renegotiate that in a year. If it goes up, it's an opportunity. The buyer is leveraging the fact that the market may go up and that they're going to do well on that purchase. Chances are if the market goes down by 20%, which I don't think it will, they just won't close on the property. But you still have covered your payments for the last year with a tenant. You can spell out agency in here, title insurance, a home warranty plan, all the things that you're used to looking at. You can put miscellaneous terms in there. Then we have a disclosure deadline, due diligence, settlement deadline, very similar to our purchase contract. And then along with that is this notice of intent. We'll want to spell out and have a time frame that the tenant gives notice that they are not going to close. Typically, you would want that to be a couple months before the closing deadline. So as a landlord or as the owner, you can prepare, hey, do I have to put this on the market? Do I have to release it, or do I want to look to extend the lease? You guys have questions, or has anyone used the lease option? Want to comment on that for the group?
I have. You got to make sure your lease option money will also cover commissions and have enough for the seller. And I've also structured them where half of the commissions is paid upon execution of the lease option, and then the balance when they purchase the property. So everyone has a vested interest in it getting to the finish line.
Yeah, and that's a great, Rena, I'm glad you brought that up. That was on my list of things to talk about. One of the tricky
Say it
things,
one more time. Say it one more time. Sorry.
We're talking about how real estate agents get paid on these deals.
Yeah, no, but what was the terms that you said do half now and half when? Sorry.
Of the commission.
Yeah,
So
half when, and then when's the other half?
Half when you execute the lease option, and then the balance when the lease option is exercised.
So my advice on that for agents is to always get as much money as you can up front. A lot of times I've seen us, have to delay that, and we can do it. The brokerage will take a note for commission. So if we're going back to the seller financing deal, technically that commission is due when we close the seller financing, not when they refinance it. So again, you can have the buyer pay part of your commission, the seller can pay it. And if there is an equity, you can do a note, much like Rena said. You could say, I'm going to put a note. If you still owe us $9,000, I'm going to include that with the note that escrow specialist is paying. And then we would get a payment of $300 or whatever it is every single month as part of the term of that deal. You could also, like Rena said, if you can only get half of it up front, you could specify that the remainder of the commission is due when the note is refinanced in 12 months or 3 years, whenever it is. I'm all about you guys getting paid now, but if the choice is between never and later is better. And again, as a brokerage, we've done it before. We've held notes for commissions, and we would support you in that. But also, I would think try everything you can to try to get paid up front. On the lease with an option, if you believe you're going into this and it's a very high likelihood that your buyer is going to close on it, then I would require that the seller, at least half of that option money goes to you as payment or prepayment of that. And then, you get paid the rest when they close on it. The other thing is you could charge a commission for the lease that's due when they move in, and then you get paid for the sale when they actually close on it. One might be another way to do it also. I think the pushback you would get on that, Rena, on a lease with an option, just so you're prepared for it, is if I'm the seller and I say, hey, you brought me a tenant essentially, and I have option money, but if they don't close on this thing, I don't really feel like I ought to pay you a full commission on the closing because I don't know for sure they're going to close. So that's just, again, if everybody's mindset is we're just going to do this lease option for 3 months, we've got a highly qualified buyer and they're putting, you know, a significant option money down, then probably the brokerage ought to get paid. And I think if there's that much money, then I would recommend you go right to the seller finance. The other advantage of the seller finance is it's easier than to just get a refinance as long as you've been on title for 6 months. And this is another reason why I don't like the deed for contract, is that if you've been on title for 6 months, most mortgage companies will then give you a refinance because you are the owner. And as long as you're not taking cash out, it's a little easier to get those than a purchase contract in most markets. Any other questions on lease options, guys?
Boyd, it's Rich. So
I didn't know all the brokers were going to be on this. I would have tightened this up a bunch, Rich.
On the exclusive right to sell, the moment someone signs the notice of interest, the commission is due on a lease option. So make sure you have that conversation, because oftentimes people will have a 1 or 2 year lease option and they'll sign that notice of intent month 1, even though it's not due for 24 months, and now that commission is due and the money's not there. So make sure you protect yourself there.
So does it trigger that the commission is earned, or that's when it's payable at that time?
Well, I've had it where it's technically earned, but if we haven't collected it, it could be an argued point. But make sure that there's a specific addendum. If you're going to do a lease option, there's an addendum to the exclusive right to sell that goes over the commission, how that works. But the standard is it's paid on the notice of intent once it's signed.
Yeah, and guys, on these, if it's your first couple of deals or any, I would recommend talking to the broker when you're putting it together to make sure you are protected on this. The last thing we want you to do is go tee up a deal and not get paid on it. We don't want to put anyone in a tough position, but I mean, it is a little unorthodox on how we get paid, so you'll want to pay attention. And all of our brokers are really good. I know Rich has experience with this, Dean has, and you know, I know that Dave, I think we still have a note on one of the biggest transactions the Salt Lake City office ever did, the Powder Mountain sale. We carried a note for like 5 years on the commission of that thing. So it was a pretty complex note. And so I know that Dave's very familiar with that. What other questions, guys? I mean, hopefully that covered and was helpful for you. And I want you to be thinking about this. If people feel like they're stuck or a deal's going away or falling apart, let's try to be creative and figure out how to put things together. I've had to do this. I had a meeting this morning on a transaction I've been working on for 1.5 years, and the commercial funding has gone away. It's for an apartment deal, and this is the conversation we're having. Okay, we have the investor has equity, but they don't have the financing. How can we keep this thing going? And we're probably going to cobble the thing together in some form of a seller finance deal where a significant amount of money trades hands, the buyer's on title, and they're going to basically take the risk of riding through this next year until they can get their financing. Any other questions or comments? Something for the benefit of the group that I didn't cover?
I have a quick comment. If you're a part of any MC, just reach out to me and I can get you this video. You can share it with your people. Boyd, you're awesome. We appreciate you.
Thanks. The only other thing I would say is that we are salespeople, and don't forget, there's some selling involved in this. So I don't think you're going to find a lot of homes on the multiple listing right now listed as seller financing as an option. You can search them, and that's an option that you can put if your sellers are interested in it. And if you have a seller and you're having trouble selling or they're interested, you could put it on there. So I do think it comes down to your ability to pick up the phone and have some good communication with the agent on the other side. So if I call Rich today and say, hey, you're a great listing in South Jordan, will you do seller financing? His most likely answer is no. And if I call and say, hey, Rich, I've got a 100% qualified buyer, I've got their credit report, I've got their financials, they have $100,000 that they can put down, and we feel like they can get their financing done in 4 to 6 months. Are you okay presenting that to your seller? I think, that's a much different discussion than, my buddy Boyd is trying to get another rental property with $5 down. Okay. Any other comments from the brokers? Did we keep our license intact in this hour? Okay. All right. Thanks, guys. You're welcome to call me with any questions. Go out and do some deals.
Thanks, Boyd.
Thank you, Boyd.
Yeah.
Thanks, Boyd. You're awesome.
You're our hero, Boyd.
Yeah, thank you, Boyd.
Thanks, Boyd.
Thanks.